Good morning, traders. Today is Saturday, July 16th. Let's get started this week and let you know kind of what's going on in the markets. First things we want to talk about is the sideways price activity that's taken place in the U.S. markets over the last week or so. The custom index charts will show you that this is kind of negligible, very low momentum trading. We had some big rotations this week on the Fed expectations and a lot of news coming out of China with regards to potential credit collapse and economic collapse. GDP was lower. A whole bunch of people are refusing to pay mortgages. It really could get very concerning over there throughout the end of the year. And I think that's, as I've been mentioning for many, many months, it's a very real possibility that Asia and China are going to be the catalyst for what's taking place. In fact, I'm going to do a special video after this to show you kind of what's taking place over there and why we've got some real issues going on. Okay, so nothing has really changed this week. We're keeping our allocation levels the same, 10% stocks, 45% cash, 25% metals. Metals look like they've capitulated. I'll show you. We'll see how this plays out over the next couple of weeks. We needed to see this deep bottom in metals, which I thought was last week, but it looks like it's gone a little lower this week. But gold is holding up above 1,700, and silver was up almost 2.25%, a little over on Friday, up to 1866. So we might see a real capitulation bottom setting up right now. We could see metals start to move higher. And I will tell you the trick with metals. Metals will possibly recover, but as soon as the Fed blinks and lowers rates or pauses their rate increase, that's when you'll see metals really start to take off. Bonds we're leaving at 20%. We're likely to see a base and bottom in bonds carrying forward. The U.S. dollar strength is still quite strong, even though we had a bit of a rotation on Friday. The alternate allocation levels are 10% stocks, 75% cash, and 15% bonds right now. Nothing has changed with regards to this. The, oops, gone a little too far. The trade directions have not changed. The Nasdaq is still bearish. ES is still bullish long-term, bearish short-term. YM is still bullish long-term, bearish short-term. Dow Jones Industrial, bullish long-term, bearish short-term. Transportation is bullish long-term, bearish short-term. SPY, bullish long-term, bearish short-term. Gold is now bearish. Silver is now bearish, and oil is bullish. So these have not changed direction at all. These are the longer-term rotational modeling system trends, daily for the short term, weekly for the long term. Now, let's go into some of the indicators. The FANGs indicator, the FANGs custom index here has shown weakness last week, which is like I'm telling you, we're not seeing a lot of momentum to the upside. The markets did move a bit higher on Friday. People are starting to get a little excited about a potential upward swing, but overall this is consolidating into kind of a flag formation here, and we still have a downward sloping trend, so there's very real risk that we could see a final leg back down into this area or lower, and I think there's a very strong possibility that we need to see this final capitulation leg at this point to find some sort of a bottom in the market, possibly before the end of this year. The U.S. stock market index is doing the same thing, holding right along this support channel, which is the lower range of the standard deviation channel. As I've highlighted many weeks now, I'm looking for a low down here around the 850, 880 area, possibly in this level here, this yellow level carrying forward, possibly around 900 now. This would be a capitulation low down into this area, and you can see we are consolidating downward. We're in a bearish trend. We don't have any real upward movement. So we're not seeing a lot of momentum. That's what I'm going to tell you right now. We're not seeing a lot of momentum. Retail traders are still trying to buy into these dips, but we're just not seeing really any solid movement. It could be kind of like this or like this. We see a little bit of a bounce. We see some stalling, and then we see some real weakening. And I think it's going to come from China, Asia over the next couple of weeks. The smart cash index here is, sure that I didn't go too far. Nope, it's just resizing. Smart Cash Index, which is the global index, was weaker last week. This is partly due to U.S. dollar strength, but we're now at new lows. We've broken down to new lows here. We're coming down to this channel here, this channel line. At this point, we're really thinking like the 135 to 130 area, maybe into the 120 area. You can see this extended weakness is carrying on. And something you may want to pay attention to, this rally, if you take a look at from the pre-COVID area, early 2020, to the peak here in basically April of 2021. So now we have this move here, which is almost the same length. So this was, let's call it January to April, around 15 months. This is April to July, around 15 months. I would say over the next 30 to maybe 60 days, we should be setting up a major bottom, some sort of a capitulation low that the markets may attempt to rally out of. We need to see what that is. If you were to follow this downward, you have basically an A, B, C, D, and now we need our E down into this 120 area to be able to actually capitulate this low. So we're almost at the end of this downward cycle phase, I think, but we still have a lot of downside risk. I would not be trying to buy into anything right now. And typically the high performers that were back in this area, the innovation, technology, ARC funds, things of this nature, speculative things, are going to continue to unwind even deeper, in my opinion. The next move for the markets is going to be more what I call the Warren Buffett sector, what I call toothpaste, toilet paper, and supplies. Pepsi, Monster, like I think the party store is going to do well because people are still going to be spending money trying to provide for their families and their kids, the food, the essentials, the toothpaste, toilet paper, underwear, drinks, Pepsis, what have you. Those are going to do very, very well over the next year or so, holding up in value. Costco, AutoZone, those types of things will do really well because people will spend money they have to spend money for and not necessarily on broad speculation. Next, the metals index. This is the capitulation low, ladies and gentlemen. We really need to see this hold up or some sort of a V-shaped bottom setting up here. You can see we had the same type of V-shaped bottom here when COVID hit, and the same thing happened in 2008, 2009. So at this point, ladies and gentlemen, even though I thought this yellow brick road was going to hold up, the last 3 or 4 weeks, we've seen a very solid capitulation. We haven't seen any massive volume level yet, like we had back here with COVID. We need to see this kind of just rally back up over the next 3 or 4 or 5 weeks, back up into this area, and it's going to happen, in my opinion, once the Fed blinks. Once the Fed, if the Fed were to come out and say, we're only going to raise 0.25% or 0.5% instead of the projected 0.75% or 1% raise, that's going to be enough for the Fed, the markets, metals, to actually change direction. Until that time, the strong dollar is going to really start putting some more pressure here. We need to see this hold up, though. It's very critical that this level provides some sort of support in the near future, but I think we're going to see the Fed kind of blink. My expectation is 0.25% or 0.5% raise, or maybe even a pause, depending on what the Fed really thinks of based on internal economic data. The internal data is not showing what the month-over-month and year-over-year data is actually showing, and we'll get to that in a minute. But long and short of it, over the next month or two, I think we could get a pause by the Fed and say, we're just going to wait and see what inflation does over the next 20, 30, 40 days before we, break the market, so to say. Next, we have the valuations index. Valuations index was a little bit stronger last week, but still holding down below the 70 level. We're still in a downtrend, extended valuations decline. I think this is going to even move lower, like I told you. I'm expecting that possibly by September, October, November, we could see a bottom and some sort of a little Christmas rally. Really kind of depends on what happens overall with the market over the next 3 or 4 months. But we're seeing no upward momentum here, meaning the markets don't really have any base for rallying right now. The commodity to gold index is stalling around 2. We've seen it move a bit higher over the last couple of weeks. but we're still in a downtrend. I really do believe we're going to see a downward cycle here. This commodity to gold index may move back down into the 1.6, 1.8 level, possibly even lower. We'll have to see how this plays out. It's really just kind of sideways weakening at the moment. So we're seeing no real momentum to the upside. Next is the Volatility Index, and this is, again, one of my favorite indexes to study. You can see we've kind of just consolidated in this tight little channel. We're getting a nice little upward channel right here. If I could draw a line on this, I would. But long and short of it, ladies and gentlemen, I think we're going to see a very solid downward rotation over the next 10 or 15 days, back down to new lows. I really believe China is going to be the catalyst. Europe could be a catalyst as well. But we're really seeing a major contraction here, and the next big move down could push us down into this 4.5 range on deeper selling. And that would be a real solid capitulation, kind of like we saw back over here, or back over here briefly, or back over here. Anything down in this 4 or 5 range would be solid capitulation of an extended downtrend, possibly nearing an end. Okay, we're done with this. That's my 5-wave cycle. We will come over here to the custom indexes. This is the U.S. to global index. You can see that we are still holding up on the U.S. basis. We are at new lows on the global index basis. We're still higher than the 2017 start, January 2017, but we are well into this deep decline into COVID in the global markets. Global markets could really unwind quite a bit. They could come all the way down here into this low COVID level, which would be about another 9 to 10% decline. U.S. markets, I think, may move down into this early COVID phase, this election period right here, and then try to find support right here. The strong U.S. dollar and strong U.S. economy is kind of being isolated from the risks of the global market. And again, I'm going to do a special video about that today, showing you why global markets are the biggest risk right now, not the U.S. economy. But we still have this unwinding phase. And this is a very good picture. You can see A, B, C, D, and now we need that final wave down here for E, which is going to very likely be down here around this COVID high and around this area here, which is the election in 2020. That's where I think we're really headed before we're going to try to find support. We could get below this if some catalyst event really happens in the U.S. market. But I think right now this is the actual support zone we're looking at, whereas the global market could fall down into negative territory from 2017. And I believe China, Asia is going to be the primary catalyst. When I refer to China, Asia, remember that's a very big spectrum or geopolitical range. You're talking not necessarily Japan, but Japan could be part of it, but most of Southeast Asia and Eastern Asia. But you're also talking about Eurasia, where we have Pakistan, Uzbekistan. All those other areas could be into some very severe contraction over the next 10 to 12 months, maybe longer. Whereas the U.S. market is staying fairly isolated, fairly safe actually, because we don't have the credit risk and credit liability that many of these other countries have. Okay, the Custom Global Asset Index. This is a good measure of how assets are holding up. Particularly the U.S. market assets are holding up very well. If we were to break out of this range down here below this, call it 68 level, remember this is an inverted chart, then we would be looking at a major breakdown in global assets, and this is something we have to be aware of. If we stay in this range, then typically global assets are holding up. Inflation is causing assets to stay fairly stable. If we were to break below this range on this chart, then we could move back down into these 2019 assets, which would be a very deflationary cycle phase. We've seen this downward trend. We've seen downward trending in RSI and stochastics. We're holding up okay, but we don't know where that final leg is going to lead us. It could consolidate over here for a bit, or it could break down into this 75-80 range, which again would put us way back into this 2018-19 valuation level, which would essentially be a 20 to 25% valuation drop in global assets. So right now we're holding up, but we just don't know what's coming next. My opinion is global assets are probably going to decline at least 15 or 20%, possibly into this COVID cycle. Remember, COVID is right here. So that would put us around 70, 74, 75. The U.S. depreciationary cycles, this is a longer term chart. Gold is right now down about 1,700, which is right here in these lows, near these lows. We'll see how this holds up. This is my detailed explanation of expansionary and depreciation cycle phases. We're seeing gold weaken because of the strong dollar, and we should find support and start to rally even higher. Let me make sure we're moving in the right direction. Yes, this is the next chart. The gold custom cycle phases. You can see last month here, this is the monthly chart. This month we're consolidating. The month is not over. We're in the middle of the month. We could see a nice solid rally out of here. We've seen a rally over the last 3 or 4 months back into this consolidation range. And what I want to point out is that normally when we get a bounce and a rally, we get a little bit of stalling before we actually get the breakout move. So here we get the bounce, we get a rally, we get a stall, then we get the breakout move. So here we're getting a bounce, we get a little bit of a rally, then a stall. Next, I'm expecting a big breakout move in gold and silver to move aggressively higher. But this stalling pattern in gold right now is very frustrating for people like me. It's actually a very good opportunity for people like me and other gold bugs to be able to buy in at lower prices. If you follow the longer term cycle here, we've got a very solid uptrend, big breakout to the upside here off of lower cycle trends, lowest we've been really in a long, long time. RSI was never this low back in these areas, all the way back to 2011. This is a very solid rotation to the upside. Now we just need to see the follow through. And as I mentioned, when the Fed blinks, when the Fed says, well, we're going to pause, or we're not sure, or we're going to wait, or they don't move aggressively to stifle inflation, that's when you're going to see gold and silver really start to skyrocket. Okay, U.S. real estate conditions. Very interesting that price reductions are up near 95, 96% of the entire market right now. Prices are coming down. The blue line here is price levels. They're starting to decline. You've seen this kind of a double peak. They're starting to decline on a week-over-week basis. This is weekly data. Days on market, which is this silver line, is climbing. It's almost positive. It's at negative 2.5 or 2.6, I think. It's a 50% increase over the last weekly period. So you're seeing days on market. Basically, prices, homes just are not selling. They are not selling anywhere as fast as they used to. We were at minus 30-some% down here. We're at minus 2.5% right here. This is a 90% increase in the amount of time that actually that would be a 900% increase in the amount of time that homes are staying on the market before they're selling. And you can see here the active listing count is skyrocketing. We're now at the highest level of active listings on the market that we've seen in the last 7 years. You can see, and this is going to go higher, folks. Foreclosures are going to increase. People are going to become desperate as layoffs continue to happen and the economic contraction continues to happen. You're going to see the housing market shift dramatically. Could turn into something like a 2008, 2009 collapse, but it's a little too early to tell. Right now, this is telling us that housing is in the dumps. It is people are trying to get out of the market at the highest price possible. And prices are declining, days on market are declining. Look at this, price share reduced is still moderate, but it's dropping. So understand that price reduced share year over year is getting we're seeing more and more houses being reduced. We're just not seeing them being reduced by large amounts right now. 8, 10, 20% in the U.S. is probably what you're going to see over the next year-over-year basis. Remember, this is year-over-year. Come the end of this year, this could be quite a bit lower. You could be looking at negative numbers on price reduced share. It could be a very interesting scenario. Next is the Consumer Engagement Index. Consumers are actually engaging, and again, this is based on correlative of consumer activity based on IYC compared to the SPY, basically. Consumers are, and retail, this really tells me that retail traders are trying to buy into this dip right now. Consumers are actively trying to think that the U.S. markets have bottomed. This is the end of the move. This was our capitulation phase. I don't see that happening with a lot of validity right now. I don't see a lot of momentum in the markets. This could be traders trying to buy into this dip. This could be traders thinking that the markets are going to hold up and that the U.S. market is immune from risk. I don't see that happening. I think the liability risks, when you start thinking about the hundreds of trillions of dollars that have been created over the last 7 to 10 years with regards to foreign market derivatives, mortgage solutions, expanded speculative trading, real estate, particularly in Asia and China, I think the risks to the U.S. market are still quite extreme. I would say that the U.S. liability in some of these could be 20, 30, 40% of global invested assets. So we are seeing a lot of buying taking place, a lot of speculative buy the dip right now. I'm going to tell you to stay very cautious. This could change very quickly. Next, we have the Technology Ratio Index weakening. Technology is not, in my opinion, technology is not where you're going to find a lot of opportunity right now. Maybe closer to the end of the year, maybe August, September, October, we'll be looking at this differently. But I see technology as unwinding. I see the higher interest rates as providing a real headwind for technology stocks, and I see consumers eliminating, their Netflix and their Disney accounts and what have you, and really consolidating around what I call the toothpaste and toilet paper phase, which is just the essentials. So I would tell you that we could see a move back down into these areas over here, which would put us down over here. Another potential 11 to 15% down in technology. And I would urge you to be extremely cautious. Buying the dip right now in anything other than, for example, Costco or Monster or anything that's kind of that toothpaste and toilet paper phase is very, very risky. You still have a number of stocks that are going up. Like I told you, Costco, AutoZone, I think Party City is a good investment. I think Johnson & Johnson, things of this nature are good investments longer term. But trying to buy into a technology company or a technology sector right now is not very smart, in my opinion. Wait for it to bottom. Okay, and this is a older chart. We will go back here and move over to here. Here we have the custom U.S. devaluations index trend. The point behind this chart, ladies and gentlemen, is to show you that we are in this downtrend. We're finding support right around this level, just like we talked about last week. We had a very deep low last week, and this is a monthly chart, last month. We had a very deep low set up. We're seeing some support here. I really do believe we're setting up kind of a false bottom here, kind of a, I don't know how to explain it other than a dead cat bounce. I really believe we need to see some sort of capitulation to the downside, which is why risks are excessive. I'm not urging anyone to get overly aggressive trying to buy into anything other than what I just told you, the good safe haven. Think of them as consumer staple stocks. I think you'll do very well putting some money into those, maybe 5 or 10% throughout the end of the year. But long and short of it, it's just too risky right now to buy into this dip, knowing that we have a number of potential contagion events taking place. And like I said, China really is on my focus right now. I think that there could be some really big news hitting over the next week or two out of China and Asia and other areas that could really disrupt the U.S. and global markets. So pay attention. We're still in a downtrend. We do not have any divergence. We've got lower low here, lower low here. We've got convergence here, convergence here. It is trending lower. The next phase, hypothetically, would be a bit of a lower low back over here, possibly over the next 6 to 8 weeks. And then we might get some divergence, and we may set up some sort of a bottom going into the end of the year. So again, be very cautious of what you're spending your money on right now. Don't get overly anxious trying to buy into this potential bottom right now. Okay, so here is the general large cap index. Large caps again showing support. This is a monthly chart. It's showing some support here, getting a bit of an upward trend. As I mentioned to you, and let me come back over here to show you that we're getting some support, okay, in the large cap markets, in the U.S. markets, but we're not seeing that really show up in support here. This is the volatility index. So we're getting no momentum to the upside. Very, very slow momentum to the upside, which is why I'm warning we could still have that final leg to the downside. Again, I would say if we had seen this type of a move, a 600-point move in the YM, and we had seen this kind of move that we're seeing in some of these other charts, like for example here with the upside move here this month, to me, I'm just not seeing that real momentum, that follow through, which is why I'm warning we could see a very strong downward move, really shaking the foundation of the markets, setting up a real capitulation low. And I really do believe that we're looking at that as a setup going into the next 2 or 3 weeks. So be very, very cautious. And primarily, like I said, we're just not seeing any follow through here. We're not seeing any real volume to the upside. Let me come back over here, try to show you something that's got some volume. Well, that's the metals index. Let's try, this doesn't have any volume. Here we go, the FANGs index. So we had a bunch of selling volume right over here, just like we had back over here. Then we get this basing bottoming formation, and we're looking for accumulation. We're not seeing a lot of accumulation yet. We're seeing still a moderately strong degree of selling, even though we're not really seeing that accumulation yet. So ideally, ladies and gentlemen, I would be looking for something in the FANGs index back down in this area, near this 618, or potentially just below this 618 level, in the 420, 430 range. And that would be enough for me to say that we have some sort of a basing bottoming formation. Otherwise, we're just not seeing the capitulation or the accumulation. We're seeing right here, we're not seeing the accumulation take place here. Otherwise, we would see the volatility index up above 10 or 11 or possibly into 12. That would show some real accumulation. Notice back over here, we started to get accumulation off of the base and the bottom. Then we had this weakening move. Then we moved back up above 8 here, 9. This was just before the elections. Then we got into the election rotation here. Then we started getting into accumulation right over here. So we need to see this kind of move back up into this 9, 10 range to see some real accumulation. Okay, so now what I want to do is highlight the TT scanner, which is, this is the inverse TT scanner. We've got no new triggers here. We've got a flat trigger here in the drip, gas and oil production, bear 2X. So that's gone flat last week. All the other triggers are still holding their own. This has been, TMV has been long for 12 weeks. It's got 4.7% profit. SJB has been long. That's a short high yield. Has been long for 2 weeks. It's down 1%. We've got TBX, the 10-year, 7 to 10-year Treasury shorts, long for 14 weeks. It's got 3% profit, hit all its targets. The Yang Index, which is the China Bear 3X, is short. It's minus 21% profit. That's going to be a pretty big rotation here, but get ready. This is a short trigger, so this could be ending fairly soon. We have EFZ, is been 2 weeks in. It's got 3% profit, almost 4. We've got Webs, got 11 weeks in, 28% profit. We've got EUM, the MSCI, Emerging Markets. It's been trading for 12 weeks long. It's got 11% profit. And we've got ZSL, Short Silver, 1 week in, got 8% profit. Now, the non-inverse core list has got one flat trigger here in ARKK. We've got a number of existing triggers. Some have been in for, this one's been in for 64 weeks in DBA, the agricultural commodity sector, up 12%, up 11% in XLE. This is 10 weeks, up 10.5% in HACK. 29 or 26 weeks here in IGE, up 3%. It's already hit both targets, by the way. This has been 9 weeks in a short of MJ, has already hit the first targets, up 29 or 26%. So you can see we're doing pretty well in these cyclical trends. Now let me come back over to here and get the new TT scanner. Here's the new TT scanner image. This is our primary modeling system for ETFs on a weekly basis. And you can see we have one new trigger here, short. Oops, let me move this over so we can see it. And one new trigger here in XLB. That's the materials, raw materials. Otherwise, we have a bunch of existing triggers. We're still long XOP at 4%. We're still long XLE at 11.5%. Bunch of new short triggers here. And you can see here we've got, let's see, this is 2 weeks old. XAR is up 1.25%, 1.5%. This is 4 weeks old in JETS, up 3.5%. Still hasn't hit the targets. This one is 3 weeks old in SOXX, minus 2.17%. We've got a new trigger here in GDX. It's up 7.5%. We've got a new trigger here in Nugget. It's up 15%. A new trigger here in GDXJ two weeks ago. It's up 14%. So we're getting a pretty big move in the markets. And like I said, pay attention to this potential capitulation low in metals. I'm going to warn you that this looks very solidly like a capitulation bottom in metals. I'm going to come back over here to the metals index. I'm watching this like a hawk to see what happens around these lows. Okay, so lastly, I just want to highlight where we're at with these trends. And again, we had this pennant formation in the S&P and the Nasdaq. We broke out of that pennant formation. Based on my technical count, we've got an A, B, C, D, and now we've broken out. This could be a false bottom. We need to see. It is a new low. It held up. This is a daily chart. It reversed back out of this, back into the apex range. I'm very fearful that this could weaken early next week and try to push down into this lower price channel that I highlighted, back into this below 3,400 is what I'm really looking for. So pay attention. We've got some volume rotating through the market here. I think traders are expecting the Fed to readjust to what's happening. I think the Fed, though, is going to come out, and I think Powell is going to basically keep it at 0.5% to 0.75% and continue to try to burst the inflation bubble, which will push more pressure on global markets and more pressure on inflationary trends, which could move us down into this lower leg. Let's take a look here at the Nasdaq. And what we will do once this loads, my very busy Nasdaq chart, you can see we're very close to an end of cycle right here. End of cycle phase is the 26th of July. That's only about a week and a half away as far as trading days. And that means that we could, again, notice back over here how near the end of the cycle we broke down. Near the end of the cycle, we broke down before finding some support. We could come right back down into these lows in the Nasdaq, try to find some support down near this channel area here, call it 10,955. It's a very strong potential that the markets are going to weaken and try to find some support near the end of this cycle, near the end of this month. Could put us down below the 11,000 level, 10.9, 10.8, somewhere in that area, possibly down even into 10.5. So be aware that we have some very strong risk factors and we're not seeing any real accumulation yet. All right, one member asked me to try to keep these a little bit shorter, so I'm going to leave it right there. Follow me on YouTube, follow me on Twitter. If you like my research, follow me. There's going to be huge opportunities near the end of this year and going into next year. So follow me and let's try to profit from these markets. Follow my research and let's make some money over the next 5+ years as these market cycles trend. By the way, over in the Trade Tank live trades section right here, I want you to be aware that there are some great opportunities taking place over here in the currencies trades. Hopefully this, yes it does. So you can see here, we've got some, BITO is up 47% from April of this year. We've got a new trigger here in FXE. BTF is up 47%. CEW is up 3%, new trigger just about a month ago. CYB is up 4%. FXA is up 2%. FXB is up 1%. These are newer triggers. Look at some of these setups here. 2% USP. XBTF is up 47%. Now these are the standard modeling. If we go to rotational modeling, you can see some really big numbers as well. 3% CEW, CYB 4%, DBV is minus 1.5, FXA is 2, FXB is 1. These are newer triggers a month ago. 0.71 minus 2 in XFX, FXY. I'm going to just warn you, ladies and gentlemen, there's going to be some really big moves in some of these stocks, particularly in currencies, and particularly in some of these hotshot stocks. Apple's up 2.5%. I wouldn't stay long this. Look at the protection level at 147.56 right now. Really good protection level. Let's take a look down here, find some of the hotter ones. These are all newer triggers. Newer triggers sometimes take a bit of time to flush out before they turn positive. Microsoft is minus 1.47 on a short trigger just from last week. Looks like it's a pretty good short trigger. We have Qualcomm. We had a trigger 2 weeks ago. It's up 6%. We have SFY is a trigger from just a couple of days ago. It's up 2%. T-Mobile is in a new short trigger. It's minus 0.5%. UNM is in a new short trigger from last week. It's off 1.4%. Now remember, you'd only be trading about 10% of your stocks with these. So these numbers really are, if you were to take your 10% allocation, break them into 10 trade slots, this would end up being basically 0.04% loss. ABC is a minus 4%, 6.9. That would be 0.0469% loss because you're trading smaller amounts with these numbers. Acor is in here. It's a very interesting trigger. It bounced on news and is consolidated. Could still run quite a bit higher. It's still above the protection level. But you can see we've got some ARKQ. We got a short trigger at 22%. ARKW, short trigger is up 37%. Bank of America, short trigger is up 21%. These are older triggers, but they're still very, very valid, and they show you what the potential is. MD, a trigger 2 weeks old, is up 10% right now. Netflix, a trigger from December of last year, is up 69%. What a great trade. Remember, these triggers in Mint Live Trades, where you come to get access to the weekly video and the weekly summary reports, all of these triggers are still very, very valid, and they can provide you some great trade setups while you're trying to protect your capital. So understand that all of this, let me shrink this down a little bit. All of this is available to you right now. All you got to do is log into my website, come into Mint Live Trades is what it's called, Mint Live Trades, EOD, and all of these triggers are ready for you. Futures, Nasdaq, it's all ready for you. There's 60 Nasdaq triggers active. Let's take a look here. Apple up 2.8%. These are the newest ones. Amgen is up 11%. ASML is minus 10% on a short. ATVI is minus 2%. This was just a week ago. Flat, we got flat, flat, flat. CTXS is up 2%. Dollar Tree is up 1.3%. This is a week ago. Google is minus 6% a week ago. IDXX minus 2% a week ago. INCY is plus 1% a week ago. JD is minus almost flat from just a few days ago. KHC is minus 3%. Remember, these newer triggers take a while to work out. So when they're only 3 or 4 days old, you can get a minus 2 or 3 or 4% level. What you're really kind of watching for in this area, current price is 38, entry price is 39, protection level is 38 and change right here. So the closer we are to this protection level, you've got a really good entry. So this minus 2.9%, where it's at 38.02 and the protection level is 37.89, you've got a very low risk trade here. This is telling you it's a new trigger, it's bullish trending, but it's trading kind of sideways right now. This is telling you it's a new trigger, flat in MAR. This is telling you it is a new trigger in ORLY, new trigger, bullish, pretty hot right now and breaking out to the upside. So here we got a 3.2% profit on a $682 last price. Entry level was 661, protection level 646. This is a pretty hot trigger right now. This is moving upward very solidly. This is PCAR. This is now breaking to the downside. It is bearish trending. It is a new trigger. We're at minus 1% roughly, 0.8. Our protection level is 80.16. Our entry level was 79, so protection level has moved lower. We're right now very close at $80, very close to our protection level. This would be a pretty good little short, expecting the markets to move lower. This has been in a trade for only a couple of days, 2 days. Protection level is 131. We're already up 1.75% roughly. We're at 144. Entry level is 141. Protection level is 131. This is telling you that it's a new trade, it's in a bullish trend, and it is rallying fairly strongly. So spend some time in here looking around. This is a really great resource for you looking for trades, and these trades are run on a daily basis. Unlike the TT scanner, which is run on a weekly basis, these are run on a daily basis, and there can be some really good trade setups in here, particularly for trades that you like and for nice little runs. Remember, you want to try to capture profits. You want to try to level out of these at profit targets. So think of it as a scenario where, if you get, 4 to 6% or 7%, pull some profits out and cover your cost on these trades. A lot of times the longer term trades will run. So you can see here, these are some older trades. You can see here the CSX. It's got 16% profit. Got into a trade about 3 months ago. It's bearish trending. It's hot because it's making some money. And you can see here, this is telling us that it's consolidating a little bit. This is CTSH. Short. It got into the same trade about April, 23% profit. It is bearish trending. It is hot, and it is consolidating a bit. Same thing here, 41% in Dish. And remember to use the protection level. So we got in at $30.52. Protection levels at $23.74. We're currently at $17.75. So this gives you an idea where we would want to protect the trade currently within this type of a trade setup. EA, Electronic Arts, is at 4.some%, got in at 123. Our current price is 123. We got in at 128. Protection level is 126. So you can see that our protection level is below our entry price, and that means that we're protecting the trade against downside risk. It does show that it's breaking downward right here. So this could be another big move to the downside. Anyway, look, this is a great resource for you if you haven't spent some time looking at it. Please pay attention to this, and I'll probably do an update on this to show you some great trade examples. All right, that's it for today. I'll do the special update videos next, and we'll go from there.